It's time for the Your Personal Bank Show with Ferenc Toth, president and founder of Secure Estate Management. Take charge of your financial future with your personal bank. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show, and I'll tell you what, today I feel like a mosquito in a nudist colony. And what I mean by that is I know I'm there, but I don't know where to start. I've got so much stuff to talk about that it's going to be an exciting show. We got lots of stuff to cover, so let's just jump right into it. Anyway, the bottom line is, of course, we've been talking in the last few weeks about the Your Personal Bank concept and really the idea of what is it? And again, it's a financial concept that strategically integrates to the financial tools from both the banking and the insurance industry to create positive arbitrage on funds, you know, even when you use them for other purposes, you know, buying stuff, investing in stuff, supplementing retirement, whatever that may be. So that's basically the general gist of it. And, you know, some folks, like the infinite, you know, the insurance banking concept is known by different names and things like that. If you're familiar with that, some people are getting more and more so, which is great. This is taking it to another level, okay? By bringing in the bank line of credit piece, it just takes it to a different level, and it's more effective. It works better, and again, you get a better return on your money. Here's the thing, you know, one of the things I really want to touch on, I've been working with a lot of clients recently, a lot of questions. I just want to touch on some of those things that have been coming up, which is great. And one of it is who should be looking into this? Who should consider this as part of their portfolio or a financial tool? And there's several different types of folks. And I think the first one most of us are familiar with, it's, you know, pretty simple and pretty logical, frankly, is diversification. You see, most folks that invest understand, especially if they're investing in assets that have the potential of risk, of loss, understand diversification is a key strategy to mitigate that loss or those potential losses. So by diversifying your monies into various different buckets or strategies or whatever you want to call it is vitally important. And this is a tool that's outside of Wall Street. It's outside of the markets, as most of us are familiar with, okay? So it's truly can become a great diversification tool. You know, again, we do have index strategies, okay? Those are more, but we have the fixed options. And right now, you know, we got options. We have companies are paying over 6%, okay? You know, and that's tax favored, by the way. So if you're looking for a diversification strategy, you get a steady, consistent return on some of your monies, okay? This is certainly a place to take a look. It just makes sense from a diversification standpoint. I'm not going to spend a lot of time with that because most people understand that. That's, you know, don't put all your eggs in one basket kind of approach, which most people adhere to or should probably. Anyway, the second type of folks that really should look into this are those that are looking for interest or dividend type, you know, income. Okay. So that typically, obviously, is someone who's nearing retirement or is retired, or just, you know, has a need for income. Okay, and they want some of their money to generate, or in some cases, all of their money, generate that income or those dividends or whatever. And so there's a lot of different options out there that people look at. But when you consider, and this is really cool, when you consider we have companies that have been paying 6% plus dividends for the past 25 years. And beyond, who have paid dividends for, in some cases, over 150 years consistently without missing a dividend. So that's going through the Great Depression and everything without skipping a beat on that. That is something that's certainly worth considering and looking into. I know it's a different tool outside of the normal box of what a lot of people do look at. But you know what? If you consider it and just look at the facts, it just starts to make some sense. And that's the thing. When I talk to people, it's just like the responses and comments I get is all the time is, well, why aren't more people doing this? And I said, well, frankly, it's probably because they just haven't been introduced to it or just haven't taken a serious look. Finding which company is paying the best dividends can be challenging. And even for those of us in the industry, it's not something that, you know, there's so many different insurance companies out there, and getting their dividend history is not an easy task, okay? I was fortunate. As you know, I've been working with a number of banks with these bank line of credits. Like I said, we got accounts that are paying 6%, and the bank line of credits, we can go to as low as 3%. By the way, we've also negotiated with banks. This is really cool for our clients. Normally, the minimum line of credit is $60,000, and you can get that 3% rate today. So if your money's growing at 6 and you're getting charged 3, if you access it through the bank line, what's your money doing, right? We also, if you have a smaller amount, we've got, one of the banks we work with has agreed to do lines as low as $20,000. The rate on that is $3.95. So my point is, look, if you're making 5-6% on your money, well, you make 6% on your money, let's put it that way these days, and have been able to for the last 25 plus years, by the way. So this is nothing new. And you're making 6 on your money and you access it and you're getting charged 3 or 4, depending on how much you have. Well, what's your money doing? Well, it's still growing, and understand that a minute. This is another key financial literacy point that's so important to understand. See, growth on your money, return, is important. I'm not going to argue that point. It is. The problem I run into a lot of the time is folks overly focus on that, almost to the exclusion of other factors. See, to grow wealth, yes, growing your money, getting a rate of return, and those kinds of things are vitally important. But the other parts are, what's the tax implications, of course. And then the other big part is this. When you access and spend those dollars, whatever that may be for, again, paying off debt, purchasing items, investing other things, supplementing retirement, whatever it is you're doing with that money, what's the return on the money after you've spent it? See, this is where the personal bank concept really separates itself from other options, from other financial tools. And when I ask that question many times, well, people a lot of times look at me rather puzzled. Like, what do you mean? Well, I spent it. It's gone. Exactly. Once you spend your money out of any investment account of any kind, pretty much, that we know of, guess what happens? It's gone. Your returns on those money no longer happens. Again, using the personal bank concept, using the cash value insurance tool with the bank line of credit allows you to earn interest on dollars you've already spent or after you've spent them. Currently, like I said, 6% on the crediting side, you earn 6% in the policy, you access it through the bank line of credit, and again, if you have $60K or more, 3%, you get charged. So you're going to be 2 to 3%, depending on how much money you're getting, 2 to 3% positive arbitrage on your money that you've spent. Here's the key. Pay it. This is where I need you to pay attention for a second. I know this is radio. A lot of people are listening in the background and all that fun stuff. That's great. But this is return on your money, positive arbitrage, your money growing after you've spent it already. That's the difference. And growing wealth is a combination of growing your money and how much is going out. So it's the inflow and the outflow. And if your money can still grow even after the outflow, you can continue to grow wealth. What does that do? Well, for those who are looking for dividend payers or interest paying type of assets or income type assets, because they want to, supplement retirement or whatever. Well, if you're still earning some interest on your money after you've spent it, after you've supplemented retirement or whatever, doesn't that mean you're going to have more money in the future? The answer is yes. Each year, if you're getting a positive arbitrage, 2-3% positive arbitrage on your money each year, that means the next year you're going to have 2 or 3% more. Why is that so important? Well, that goes a long ways to addressing the number one concern or fear that people have in retirement, and that is, will I run out of money before I run out of time, right? We don't know how long we're going to live, and we don't know how much money we're going to have. But if our money is still growing, even after we've spent it and used it, it means we're going to have more money, doesn't it? This is powerful. Stay tuned. I'm going to talk more about this in the next segment. But for more information, contact us at yourpersonalbank.com. See you on the other side.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back. We're talking about a lot of powerful financial concepts. We're talking about the Your Personal Bank concept, again, using a high cash value insurance policy to grow cash. We have companies that are paying 6% today and have for every year over the last 25 years. I've got a chart. I can show this to you. All the high dividend paying companies over the last 25 years. This was put together by a financial institution. This is pretty awesome. This is not easy to obtain information. In fact, this financial institution has put this together over the past 25 years. Where did I get this information from? Or why do they have it? Well, again, we're using a high cash value or high dividend paying policy. Again, 6%. And for the past 25 years, that or higher every year. And never missed dividends for over 100 years. So these are significant, long-term, solid, A-plus rated, dividend-paying companies, okay? We bring in the bank line of credit. You use the cash in the policy as the collateral for the line. The companies are paying 6% on the dividends, and they're charging 3% on the bank lines of credit, which can give you a 3% positive arbitrage on your money after you've spent it. So one of the things I tell people is, look, your money can grow right now, grow at 6%, tax favored, okay, tax deferred. You don't pay tax on it as it grows. And if you access it through the bank line of credit, there's no 1099, so no taxable event, and you get charged 3%. So if your money's growing at 6.1 and you're getting charged 3%, what's your money doing? So leave it in there. You're going to grow. Your money's going to grow at 6%. You're going to get credited 6%. You take it out, you access it, you still get 3% positive arbitrage. If you have the right, again, if you have 60K or more, we can go down to 20K and still get you a 2% positive arbitrage. That is powerful, folks. That makes a difference in wealth accumulation, growth, and most importantly, makes a huge difference on how much you have to spend over your lifetime, particularly in things like retirement. So this is why you really want to look into this and consider it. Now, this chart I was telling you about, I can show you all the top dividend-paying companies over the past 25 years. And this was put together by a financial institution. What I did is I've been in touch with a number of these banks, who do this lending, do these collateralized line of credits. This is a very specialized area of lending. I've been able to identify literally a handful of banks in the country that do this. And I've had meetings with all of them and asked them, who else do you know that's in this space? And they keep giving me the names of the other 3 banks. So that's the only ones they're aware of. So we're pretty confident there's literally only a handful. And I got to thinking about this. Nobody analyzes these policies and the cash growth on these policies more than these lenders, because this is the collateral for the loan, right? So they're looking at, dividend rates. They're looking at stability of the company, ratings, because they're putting their money on the line, right? So that's pretty strong. In other words, honestly, I would listen to a lender. If a lender says, I'm willing to lend money against this product versus that one, because they're not willing to do it with all of them, by the way. There's about 12, 15 of them. There's a little bit of crossover, but there's about a dozen companies that the lending institutions are willing to lend against, okay? Do these bank line of credits. These are the solid dividend payers. The more cash, the better, because that strengthens their collateral, right? So that's what they're looking at. So I asked them all, I said, who do you see out there right now and historically, who's out there paying the strongest dividends, solid companies, solid cash values, all that good stuff, ratings, everything, those ones you're willing to loan against. And one of them gave me this chart and shows, again, the dividend rates of all the big dividend companies over the last 25 years. This is strong. For me, this is solid gold. I've been sharing this with a number of my clients recently, and I'm going to tell you this. The institution asked me as a personal, it was a favor not to put this out, and they know I'm on the radio, on my website, radio. They said, because they invested a lot of time into putting this together, and they don't want their competitors just, jumping on board. And I appreciate that, and I respect that. They said I could share that, of course, with anyone I speak with or meet with individually. So I'm going to tell you this. If you want access to this chart put together by this financial institution, showing you the top dividend-paying companies and what they've paid every year for the last 25 years, I'll be happy to give it to you. But, we need to chat. And we can do that on GoToMeeting or on the phone. Contact me at yourpersonalbank.com. Let me know a good time to reach you. I'll be happy to do that. We can chat for 20, 30 minutes. I'll show you how this works. I'm not going to sell you on anything. I'm going to educate you, just like I do here on the radio. Because here's what I found. Just about every single situation when I sit down with somebody, okay, I can say this isn't for everybody, okay? That's a fair statement. But I can say with personal experience, a very high percentage. Now, I'm talking at least 80, 90% plus, okay? That's just based on my personal experience of doing this for years. When I bring this to the table and show people how this works and how it can benefit their financial position. Over 75, 80% of them do it. I don't have to talk them into it. I just educate them. And then I always say, you're big boys and girls. If you see something that's going to benefit you, and I can educate you so in a simple manner so that it makes sense and you can see the benefit to you, most of the time people make the right financial decision for themselves, okay? So that's really what it's about. I'll show you this chart. I have no problem. And you'll see immediately when you look at it, and I'll just tell you this much. There are 3 companies out there that have basically paid 6% or more pretty much every year for the last 25 years. And currently are paying, and there's 3 left today that are paying 6% or greater. These are common household names. You'll know who they are. You'll recognize them. But for, I don't want to step on anybody's toes on the radio, but I'll show you. And these are the facts. I'm not trying to pick on or knock on any one company or another. I'm just showing you who's going to pay the best dividends. And if you're I was starting to say in the previous segment, who should be looking into the personal bank concept? I stated, first of all, somebody who's looking for diversification. They want some guarantees, some safety, some tax benefits, things like that. They don't want all their eggs in one basket, for example, in the markets or in assets that has potential for risk. Everything we deal with is the principal is guaranteed at the very least. And if we're dealing with the fixed, steady options, we're looking at 4% contract guarantees, current rates of 6% plus, and have paid that every year for the last 25 years and beyond. Okay, that's the kind of returns we're talking about. Okay, tax favored, and again, if you access it through the bank line of credit, which we of course encourage you to do so because they only charge you 3 and you're earning 6. So what's your money doing? There's no tax consequence. Okay, there's no 1099 issue because a withdrawal wasn't taken. You took it from a bank line of credit. Yes, there's interest, but remember the interest you're getting charged is at 3%, and the interest you're getting credited is 6.1. So what's going on? Right? It's being smart use of your money. Another financial literacy concept. In other words, strategic use of debt. If you have money growing at 6%, for example, and you access that money and you're getting charged 3% to use that money, what's that money doing over time? Growing. That's called positive arbitrage. That's what I'm talking about here. It's not complicated. Some people try to make it so, but it's not. Contact us at yourpersonalbank.com for more information. Again, I'll be happy to show you that chart, and I'll show you the companies. And again, you'll immediately know who's paying the best dividends over the last 25 years. You'll see the rates every single year of what each of these companies have done. And you'll immediately know which companies you want to work with. Okay? So the first step is how much are they paying? Obviously, you want a high dividend payer, long-term consistency, right? All right. Secondly, then the other piece of it is, what are the fees or costs, okay? Like with any investment, there are fees and costs involved, right? The lower the fees, the more cash, right? So we want among the highest dividend payer with some of the lowest fees. I'll show you that. I can show you head-to-head comparison numbers, okay? One of the things I say to people all the time is, look, you don't have to like me or trust me. I mean, it's nice if you do, of course. It's preferable, but it's not necessary. Let the numbers talk. Let me show you the numbers. And again, you're intelligent enough. Gosh, you're listening to Money Radio. You're somebody who has an interest in learning more about money for you and your family and your business future, right? So you're intelligent enough to look at some numbers and to determine what makes the most sense, okay? So again, bottom line, we're looking at the best dividend payers. And if you're looking for that type of person is looking for dividends, looking for interest, looking for returns, well, take a look at this. 6%, long-term, consistent, tax-favored. It's worth looking at. Stay tuned. We'll be in the next segment. I'll get into this a little bit more about who should be looking into this and why.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back. We're talking today, of course, about the Your Personal Bank concept. What is it? Real simple. We're combining bank tools with insurance tools to create positive arbitrage. It's a strategic alliance, if you will, to create positive arbitrage on money even after you spend it. Look, you put it into one of these accounts. I keep talking about the fixed option because, that's 6.1% we can get you right now. That has guarantees, tax favored, all that good stuff. Long-term history. I can show you the chart of all the big dividend payers. This is put together by a financial institution given to me for the past 25 years. And for those of you, if you ask for it, they've asked me not to put this out as public information. They spent a lot of time putting all this together, and they don't want their competitors just grabbing it. I get that. But they've allowed me to share it with people individually. So contact us at yourpersonalbank.com. Let's schedule a 20, 30-minute meeting on the phone, go to meeting, whatever. And let me share, and we'll share with you how this works. You'll understand very quickly. I'm not going to sell you. I'm going to educate you. And we'll look at how it can impact you positively, financially, your financial future, and you'll know how to get some of the top dividend payers out there. Okay? And then the bank lines of credit, if you got $60K or more, we're looking at 3% on the bank line of credits. If it's $20,000 or more, it's 3.95. So my point is simple. If you're making 6.1 credit, you're getting charged 3 or 4% interest when you access the funds. What's your money doing? Remember, this is on money that you spent. This is on money you used elsewhere. Why is this so important? We all have expenses. We all have bills. We all purchase things. We all invest in things, or most of us do. Okay? So why not pick up an extra 2 or 3 points on funds that you're using or utilizing or plan to utilize at some point in the future? Leave it where it is and make 6. No problem. Again, tax deferred. No problem. Access it through the bank line of credit. No taxable impact. No 1099s issued. So you basically have clients that are growing their money on a tax-free basis, accessing it through the bank line of credit. No taxes, and there's no tax implication. So they're accessing the funds tax-free, aren't they? There is interest on it, but again, the interest is getting charged at 3. You're getting earning 6. What's the money doing overall? It's growing. You're making more. By the way, if you're using that money for business purposes, my business folks love this. Real estate investors and all those types of people. Why? Well, access to funds. By the way, typically 60 to 90% access day one, depending on how we structure it. And your situation, of course. That's pretty typical. But the interest on the bank line can be deductible if it's used for business purpose, typically. Okay? So you can grow the money, it's on tax-free basis, basically. Access it through the line of credit, no tax implication. And if it's used for business purpose, you can get a deduction on the interest. How's that for a combination? And pick up positive arbitrage all at the same time. So one of my statements all the time is, look, if you're investing in something, and gosh, this is Money Radio, there's a lot of folks that are investing in things. Why not take a look at this? Fund your money, flow it through the personal bank, access it through the bank line of credit. Remember, this is different. This is another level we've taken from the insurance banking concept, okay, that most people are familiar with. My bottom line point is this. Flow it through here, put it in the policy, access it through the bank line of credit, pick up 2 or 3 points extra. You want to reinvest in whatever it is you're investing in? Go for it. See, I'm agnostic when it comes to that. If you like investing in the markets, or you like investing in real estate, or cryptos, or precious metals, or anything else out there that you can think of, if that's your thing, if you like investing in those things, I'm your best friend. I'm an advocate, okay? I'm going to tell you, then if it works, keep doing it. I'm not going to get in your way. I'm going to encourage you. Now, obviously, if it's not working well, stop, do something else, or change it somehow, obviously. But if it's working, I'm not here to get in your way. That's a common misconception. And unfortunately, a lot of advisors out there, there's a lot of, they don't want you talking to somebody else because there's a turf war, a turf battle, if you will, right? They're protecting their turf. Does that make sense? You're their client. They want you to listen to them. And that's perfectly understandable. That's human nature. That's natural. That doesn't surprise me at all. But here's the thing I want you to understand. I'm not the enemy. I'm not the competition. Okay? I'm not a threat. Most advisors don't realize that. Okay? They just don't. But I'm not. And here's the other thing you need to understand. This is your money. This is your future. This is your financial future for your family, for your business, for yourself. Getting advice from somebody is all well and good, and I encourage that, and you should. But what I am saying is be open to looking at other options for diversification purposes, as I stated earlier, for dividend or interest or income purposes, because this will satisfy that very well. Okay. And by the way, you can actually enhance your returns, whatever it is you're doing. So if you come to me and you show me you're making 7% annual average return, for example, great. We can make it 9 or 10. If you're making 10% return, great. We can make it 12 or 13. You see what I'm trying to say? With tax benefits, with guarantees built in, okay? And lots of liquidity. That's the thing. That's, again, the key is we need to chat. You need to contact me, yourpersonalbank.com. We need to take 20, 30 minutes. I assure you, in that amount of time, you will know very quickly if this makes a lot of sense for you or not. And like I said, the vast majority of the time, it does. Based on experience, I've been doing this for years and years. So I guess that's what I'm trying to say is, look, just take a look. It's worth it to do so. Okay, I'm not trying to be difficult. I'm not trying to be pushy or anything else. The preconceived notions that are out there and the negativity in our industry to this product or that product, we hear it all the time. We hear, annuities are bad or insurance is this or bad or, I've heard everything, don't listen to this person or don't. The general statements, the blanket statements that are made, pay off all your debt, annuities are bad, or any other of those kinds of statements are nothing more. This is what you need to understand. Too many people listen to that, sadly, and it gets people's attention. It's attention grabbing. But here's the facts. It's doing nothing but showing the bias of the person sharing that message. Often it has nothing to do with your situation. They don't even know what your situation is, and many times doesn't even apply to your situation. Talking to an advisor, an individual person that looks at your situation, looks at your fact pattern, is powerful. And the personal bank concept is very much a specialty. It's not known very well. It's heard of, sort of, kind of, by people, advisors, whatnot. But it's just not a very well understood concept. This is my specialty. This is what I've basically focused on. I've been in the industry 22 years. In the last 7, I've basically focused almost exclusively on this. I'm a specialist, okay? Most people understand that in the medical field. It's funny. In the financial arena, a lot of people say, well, you don't do everything, blah, blah, blah. And they look at that as a negative. I look at it as a positive. No, I'm not an MD, like a medical doctor who does a little of everything. I'm the surgeon. I'm the brain surgeon, okay, or the heart surgeon, somebody who does something very specific, but does it very well. And that's the thing. That's what you want. So if you're looking for something where they can really enhance your financial position, your financial future, and it's something you've probably never been introduced to or looked into very much, this is what you want to look into. Again, it can create a positive arbitrage situation, increase your returns, enhance your returns, whatever it is you're doing. And I'm going to encourage you to keep doing what you're doing if it works. It can create tax benefits for you. It can create more liquidity for you, access to funds, okay? It can do all those things for you and be a great diversification tool. Stay tuned, yourpersonalbank.com. Contact us for more information. I'm going to wrap up with some additional information that you're going to find interesting, so stay tuned.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
All right, we're rounded third, and we've been talking about the personal bank concept, of course. And what is it? Real simple. We're using a bank tool with an insurance tool to strategically integrate these two to get you return, tax benefits, guarantees, and then earn a positive arbitrage on the funds even after you spend them. What is the positive arbitrage today? Well, again, depending on the amount of funds you have, we can earn, bottom line is you earn 6% plus, okay? Long-term dividend-paying companies. I'll show you the charts. I'll show you which companies are paying the highest dividends over the past 25 years, okay, and have paid dividends for over 100 years, including the Great Depression, without skipping a beat. The line of credit, 3%. It's 3.95 at 20K more, 60K or more, 3%. So your positive arbitrage, if you're earning 6 and you're getting charged 3 or 4, your positive arbitrage is between 2 and 3%. We've got strategic alliances we've worked out with these financial institutions, these banks and such, with our clients to do this. There's only a handful of banks around the country that offer this kind of lending. It's very specific but very powerful. Who should look at it? Simple. Those who are looking to diversify, want some guarantees, want some safety, those kinds of things, want some tax benefits, okay? Don't want to have all their eggs in one basket and would like to get outside of the Wall Street bubble with at least a portion of their portfolio. So the diversification, truly diversifying your money, not just going into different sectors, but truly diversifying some of those dollars so they're outside that Wall Street bubble, okay? And they're not impacted by that, all right, with guarantees and all that good stuff. Who else should look at it? Somebody who's looking for income, dividend payers. Those folks that are looking for those dividend-paying investments, interest-earning, income-earning things. Look at this. 6% is pretty good these days with guarantees, with tax benefits. And then lastly, those that want to supplement income, supplement retirement, or want to get a better return on their monies. You want to enhance your returns on your monies? Well, it's really quite simple. Flow it through the personal bank concept. Flow it through the policy. Earn 6 on it. Access it through the bank line of credit. Get charged 3. What are you doing? What's happening? You're getting 3% positive arbitrage, aren't you? What did you do with the money? Whatever you want. Are you paying off bills? Paying off debt? Guess what? You just reduce your interest charge on your debt by 3%, didn't you? I've got folks doing, paying mortgages with this and reducing their mortgage costs by 3%. And these days, you can get a mortgage in the 3s. Okay? I have a couple that did that last week, and they got a 3.25 30-year fixed mortgage, just refied. And they're doing this. They're getting a 3.1 positive arbitrage on their money. The net result of their mortgage costs, the interest costs on this now, is 0.2%. Okay? That's the kind of thing this can do. You want to buy stuff? We all purchase items, okay? Get any big ticket items. You can pay cash for it. You can finance it, as we all know, right? Well, if you're going to finance it, why not chop 3% off the finance cost? So if you're buying a car and it's a 5% loan you're financing, why not earn 3 on it so your net finance cost is now 2, okay? By the way, if you pay cash, is that better? Maybe. Depends on your situation. Again, this is a financial literacy point. Maybe. But probability is no, because if you pay cash for a car, for example, or let's say any big ticket item, what's happening? You just lost the use of those dollars, didn't you? Would it make sense to put it in the personal bank? Access it through the bank line of credit. There's no tax implications, okay? You earn 3% on the money, positive arbitrage, and pay cash for the vehicle, but pick up 3%. Well, on a $50,000 vehicle, that's $1,500 a year. Positive arbitrage. Add that up to a decade from now. Without compounding, that's $15,000, isn't it? Okay? So it'd be more than that with compounding, obviously. Add a couple decades of that. How long are you going to live? How long can you get that positive arbitrage and compound for you? Okay? You see my point. You want to supplement retirement and you want an interest dividend payer type of or income paying asset? Well, look at 6%. But not only that, again, it comes down to this. When you access the funds, as part of building wealth. Part of building wealth is rate of return, ROI, building your money. Absolutely. But the other part is what happens on the distribution side. When you take funds, when you distribute funds out of an investment, just about any kind of investment that exists out there, generally speaking, what happens to the returns on the money after you take them out? It goes away. You spent the money. You used it, right? Gone. Here, again, you're putting in the policy, accessing through the bank line of credit. It's that simple. It's not complicated, but pick up 2-3% positive arbitrage on that money currently. And historically, long-term positive arbitrage, by the way. This chart I was telling you about, put together by the financial institutions, they've asked me not to share it, on my website publicly, but I can individually. And I'm going to honor that request because they put a lot of time and money into this. I'll show you the chart. I'll show you the companies. We got companies been paying 6% plus for 25 years in a row. Okay? Have been paying dividends for over 100 years in a row. Never missed. So if you're looking for dividend-paying stuff, interest-paying stuff, looking into this is just wise. Okay? Overlook it at your own detriment. How's that? Is that the nicest way I can put it? You see my point. So if you're looking for diversification, if you're looking for dividend interest-paying type stuff, or if you're looking to increase the returns, ROI, return on investment, you should look at the personal bank concept because it's one of the only tools out there. It's a unique financial tool. Again, we're using the tools from the insurance and the banking industry to create that positive arbitrage scenario where your money still grows for you after you spent it. So what I'm telling people today is, look, put your money in here, leave it there. It's going to grow at 6% tax deferred. You access it through the bank line of credit. There's no tax implication. There's no 1099 issued. Guess what? Your money's still growing at 3. You're getting 3% positive arbitrage overall. You're earning 6. You're getting charged 3. What's your money doing? And I like one of the interviews I did, I think it was mid-February. Go to yourpersonalbank.com. Brandon Miller interview. I think it was May 14th, I believe, or May 16th, where I interviewed the director of lending, one of the banks. And one of his statements on that interview, which I thought was just absolutely awesome, was if you've got funds and you're looking for a return or you're looking to access those funds or use those funds or supplement retirement, whatever it may be, what are you waiting for? I liked what he said in his statement. And the last thing I want to leave you with, there's a lot of folks out there with policies with cash values. And a lot of folks, particularly after COVID, have taken policy loans. And most companies' loans today are anywhere from the mid-3s to 8%. Okay, I can get you a 3% interest rate on your loan. All we have to do is connect you with the right bank. Okay? You can even keep your policy if it's one of the ones that the banks will lend against. They won't lend against all of them, which tells you something there too. They're analyzing them from a collateral standpoint. You want a policy that will stand up to a lender, the criteria for lending, okay? Because they analyze these more than anybody. So if you got one of those, let me lower your interest rate for you. Contact us at yourpersonalbank.com. Love to talk to you and help you out and change your financial future. Stay tuned. We're on every Tuesday at noon and Thursday at 1 on Money Radio, 1510 AM or 105.3 FM.
Listen next week at noon for more information on Your Personal Bank. Contact Ference at 866-515-6280 or online at yourpersonalbank.com.
This show is designed to provide accurate and authoritative information. The presenter and guests on this program do not engage in rendering legal, accounting, or tax advice. Expert advice from a professional involving your specific situation should be sought, if required. Permanent life insurance is a long-term investment. Products, optional features, and riders may have limitations, restrictions, and additional charges and may not be available in all states. Withdrawals beyond principal may be taxable income. Excessive and unpaid loans may cause the policy to lapse. If a policy lapses, unpaid loans are treated as distributions for tax purposes. Replacements may not be suitable for everyone. There may be penalties and surrender charges when replacing coverage. New products may include new surrender charges and contestability period. Policy guarantees are based upon the claims-paying ability of issuing insurance company and do not apply to the investment performance or assets in the underlying variable portfolios. The life insurance and annuity products in this presentation are not FDIC insured, may lose value, and are not bank guaranteed.